Hey traders, this is John Howell from tradinginvesting4u.com. In this video, I want to step back a bit more from viewing charts and give you a bit of education and some analysis to really help you stack the odds on your side even more when using indicators. Because I know sometimes when we're looking at the charts, we can have literally dozens and dozens and dozens of indicators, and when we're looking to get into the market, half the indicators are saying don't get in, and some of the indicators are saying do get in. So I want to give you just one indicator today called the C-stats or the stochastics, and I want to give you a bit of a guide, a bit of education, the way I view it myself, and the way you can use it yourself with your own trading, and ultimately start to stack the odds on your side even more. Okay, so what we're looking at right now, we're just simply looking at a daily stock market chart. Okay, just a daily stock chart. This could be a future chart. This could be a low cap stock. This could be a high cap stock. It doesn't matter. Okay. Just what we're looking at here is just a daily chart. Now, what we also have is we have a slow stochastic, okay, a 14/3, okay. So let me show you what that looks like. Okay, if I go to my stochastic and let's just add it there. Okay, you can see that I have a slow stochastic. Okay, so it's slow. I have a static zone of 80 and I have a bearish zone of 20. Okay, and then I have a period here of 14, but then also have a smoothing of 3. Okay, smoothing of 3. You can see that I've actually selected slow here. So it doesn't matter what you use when using stochastics, but just make sure that you just test it out. Okay, you might want to test normal. Okay, you might want to test slow with a different smoothing period, with a different period, with a different period, and a different smoothing period. So just make sure that you definitely check those. And make sure that you do some back testing and see which ones work. Because as you go through as a trader, you'll find that some stocks work really well with some indicators, and other indicators don't. Okay, so you might want to do some back testing and see which ones work for you. But for this example, we're just going to stick with the 14 and stick with the smoothing of 3. And we're going to click on slow. Have a static zone of 80 and bearish zone of bullish zone of 80 and bearish zone of 20. Let's click OK. And as you can see, this is what we have right now on our charts. Okay, we simply have. Let me just delete one of these. Oh, whoops! I just deleted both of them. Just quickly bring it back, and there we go. Okay, so actually, that's actually really hard for you to see. Let's just see. Okay, there we go. Okay, so now it's a bit easier for you. So the way I like to use this is in conjunction of trends and turning points. So if we have a nice little uptrend through here, okay, so we can see we have a nice uptrend going through here, okay. As the market was rising up through here, okay, you can see that over this period through here we have a nice uptrend, right? The market's actually stair-stepping up here, okay. But look what happens here. If we have a look at if we have a look at this low point here, as the market was stair-stepping up, see what the stochastic is? As the market was stair-stepping up, because it's in an uptrend and because we're looking for nice, powerful turning points in the market, as the market pulled back, the stochastic pulled back into the oversold section, okay, because you've got overbought and oversold. Overbought it's over 80, and oversold is down below 80, down below 20. So you can see that point there was a very good turning point from the stochastic, okay? Then what do we have? The market continues higher, and you're saying, okay, I want to look for a really good opportunity to buy this market. This market's in a nice uptrend, but I'm not sure where to buy it. Okay, well then you can use your stochastics. As the market drops down, look where the stochastic is. The stochastic starts to get into the oversold section here again, and this is where the actual market is at that time. And as you can see, it was a really nice, powerful turning point, right? Market ran up, went sideways, and we really didn't pop below that 20 zone, did we? We just sort of stayed above it for a while. Now, as the market did start to go sideways, the market really started to give you some warnings. You can see this peak up here, and this peak here was where the turning point was when the market came back, okay? Market came back a little bit, but as you notice, look at this. As the market was stair-stepping up, the market came up, reversed, the market started to really get below this 20 zone again, and this is the point here, okay? So as you can see, that was a nice little buying entry before the market popped up again. Market keeps continuing to stair step up, comes down, gives you this over the under the 20 zone, which is the oversold section, and this is where the market was. the market continues to stair step up, comes down, look where the stochastic is here, look where the market is here, okay? And once again, we can use this point right here, just below the 20, and we have that point right there. So as you can see that sometimes we can use the stochastics for overbought and oversold sections, and whether it's pointing up or pointing down or crossovers and all that sort of stuff. I think if you're just starting out, you want to use some simple tools like this, but using a bit of a powerful meaning, then what I strongly suggest you're doing is looking at it that way. Okay, if we have a nice uptrend, then if the stochastic starts to get into the overbought section, okay, the overbought and oversold section, then they are pretty good turning points. Now, again, you don't want to just trade off that, okay? You want to have your other analysis such as volume and support resistance and all that sort of stuff going for you, okay? But just by viewing the stochastics, or the C-stats as some people call it, this way, you can really start to say, okay, then, by waiting for the market to be in a nice uptrend, and as soon as we pull back, if we start to get the stochastics or the C-stats in an oversold section, you can see they're really nice, high probability turning points, okay? Because remember, when we're always trading the market, we are always trading, we're always trying to look for high probability steps, okay? Because we're not going to make money all the time, but we're looking for the high probability. And by using the stochastics here, we can really start to ramp up our probabilities by using simple analysis like that. So if you're looking to buy stocks, use this simple tool called the stochastics. I use a simple 14 and 3 with the slow. You might want to use a normal or a fast with different periods and a different smoothing. Okay, whatever works for you, just test it out and see what works for you. Okay, so use this in conjunction of your tools and your analysis right now, and you'll start to see that things are starting to go well. Okay, so this is John Howell here, and I will speak to you in the next video.